carnage of the fourth quarter last year came the recovery, with equities enjoying one of the strongest starts to a year in decades. Just as the market rout was triggered by the Fed's tightening, so the recovery was inspired by an about turn by the Fed, with an unexpected dovish shift. However, the surge in January faded somewhat, and by the end of the quarter the prevailing mood was more cautious. Nevertheless, the return of 12% from global equities in the first quarter, led again by the US, recovered much of the ground lost in the fourth quarter and left Wall Street within 3% of its all-time high. As notable as the big move in equities, and perhaps of greater import, was the move in bond yields, with sharp falls particularly in longer maturities. The yield on the 10-year US Treasury fell by 30 basis points, taking it down to 2.4%, producing a return of 2.2% for the quarter. Since the cyclical peak in the yield in November 2018, there's been a fall of some 85 basis points, an extraordinary move as we enter the 11th year of a global expansion. Bond markets around the world followed, with 10-year yields in Japan and Germany falling back into negative territory, while credit markets produced exceptional returns, 5% for investment grade, 7% for high yield, and 6% for emerging markets. During March, one of the closely watched lead indicators of recession, the 3-month 10-year yield spread, inverted. Yet recessionary fears are not reflected in credit markets, where spreads narrowed materially in the past 3 months. Despite the Fed's shift to an easier policy, the US dollar strengthened over the quarter, largely because of weakness in the euro, where the ECB also signalled a looser stance. Sterling was a notable outperformer despite the Brexit saga, as the market interpreted the endless political machinations as likely to lead to a softer Brexit. In commodities, the notable move came in the oil price, up 27% and recovering about half the ground lost in the fourth quarter of last year. Here, supply constraints arising from the reimposition of US sanctions on Iran, the crash in production in Venezuela as its political crisis deepens, and the continuation of OPEC and Russian production cuts have outweighed the continuing growth of shale oil production in the US. The key drivers of markets have been the increasing evidence of slower global growth, most prominent in China and Europe, and the response of central banks to this slowdown. Having pivoted to a more dovish, patient policy approach in February, the Fed delivered a surprise in March when, in effect, it called a halt to its tightening cycle, reducing its growth and inflation forecast and pointing to less supportive financial conditions, persistent inflation undershoots, and downside risks from Brexit and trade. The Fed removed expectations for interest rate rises this year and set out a timetable for ending its balance sheet runoff program by the end of October. This means that quantitative tightening, which significantly reduced liquidity in markets, will be brought to an end earlier than previously anticipated. The significance of this shift should not be underestimated. Its impact on markets has been amplified by a similar pivot by the European Central Bank. Having ended its QE program last December, the ECB reacted to the alarming fall in growth in the euro area and the spectre of deflation reappearing. It slashed its growth and inflation forecasts, pointed to risk to the downside, and brought forward plans to provide banks with another round of cheap financing, as well as pushing back its guidance on interest rate rises, which are now off the agenda completely for this year and probably for most of next year too. Perhaps little wonder then that interest rates across the maturity curve fell sharply in government bond markets. But surprising, I think, that yields have fallen so rapidly back into negative territory in longer maturities in Europe. Now at -7 basis points, the yield on the 10-year German government bond is close to its Brexit-induced lows of 2016 and is giving rise to comparisons with Japan, where interest rates were reduced to zero 20 years ago and have remained stuck there ever since. In China, the slowdown in growth partly structural as the economy rebalances away from exports and investment towards consumption and services, partly due to the debt overhang and the impact of the trade war with the US, produced a policy response. Monetary policy has been progressively eased, easier credit made available, and tax cuts announced. After sharp falls in 2018, Chinese stock markets have been the strongest in the world so far this year, up by 24%, reacting to that policy stimulus, as well as the encouraging signs of progress in the trade talks. China's growth rate will slow this year, with the official target set at 6 to 6.5%, continuing their gradual path to a lower level, but still, of course, contributing substantially to aggregate global growth. While less important than events in the US and China, Brexit continues to dominate political discourse in the UK and Europe, and to overhang the UK economy and financial markets. As the original Brexit day has come and gone, the political morass appears set to continue, and uncertainty is as intense as ever. It's impossible to forecast with any confidence the outcome of the latest turn of events. It could result in a long extension to the UK's exit, a no-deal exit, a general election, or conceivably some last-minute cross-party compromise enabling the withdrawal agreement to meet the approval of Parliament. The greatest fears remain of a disorderly Brexit and a general election giving rise to a Corbyn-led far-left government, which would put the short-term disruption of a no-deal Brexit very firmly in the shade. Sterling is likely to be the most sensitive market to the eventual outcome, whereas the UK stock market, undervalued as it is and heavily dependent on revenues from outside the UK, could actually perform relatively well. Investors are right to be worried about trade wars, Brexit, and most importantly, slowing global growth. Leading indicators point to weaker growth, especially in Europe. While returns from bond markets have been good in recent months, the falls in yields point to structural as opposed to purely cyclical concerns, and mean, of course, that future returns will be lower from here. Furthermore, equities have recovered a substantial portion of the falls in the fourth quarter last year, and at current levels are not priced for further deceleration in growth, nor indeed a slide into recession. However, there's no sign of inflation on the horizon, despite the length of this economic cycle and the low levels of unemployment, especially in the US. This provides considerable leeway to central banks and eases the fear of policy errors. With the Fed and ECB having turned dovish, the liquidity tightening of last year is out of the way, and financial conditions have improved substantially. Interest rate rises are a distant prospect across the developed world. Low rates improve debt sustainability for borrowers, and this has been reflected in tightening credit spreads and falling longer-term bond yields. While trade wars and Brexit remain concerns, the progress of the US-China talks has been encouraging, and both parties need to conclude a deal. The same, of course, could be said of the UK-EU negotiations, but here political intransigence is holding back a satisfactory conclusion. But it will come eventually, and the current intense uncertainty will be lifted, no doubt with more surprises on the way. Low interest rates and subdued inflation support growth, and the fiscal loosening in China will begin to have some positive impact, shoring up growth in the world's second largest economy. In the US, the consumer, the driver of growth, is in good shape and should underpin growth this year, albeit at lower levels than last year when tax cuts provided a one-off boost. While we recognise the risks, we don't share the concerns of some that the inversion of parts of the yield curve in the US point to the inevitability of a recession within the next 12 to 18 months. Global growth has weakened and is a concern, but the usual triggers of a recession are either systemic financial problems and an ensuing liquidity crunch, or excessive growth leading to capacity shortages, inflation, and a sudden tightening of policy are completely absent. Furthermore, ultra-loose monetary policy has made it easier for yield curves to invert, suggesting that recession risks are being exaggerated. The big shift in monetary policy and the sharp falls in longer-term interest rates provide strong support for valuations of risk assets. The policy backdrop will remain supportive through this year, and we expect some of the major areas of uncertainty which have held back confidence and investment, notably US-China trade wars and Brexit, to begin to lift. We therefore expect further progress in markets. However, we also recognise the risks of an unfavourable outcome to some of these events and resulting extended uncertainty, as well as the longer-term problem of excess debt in many countries, which contain the seeds of a more serious economic slowdown. These uncertainties are enough to keep investors nervous and to trigger bouts of volatility, especially following the sharp rise in markets so far this year. Some period of consolidation is therefore quite likely, but we view the medium-term outlook as broadly positive and would use periods of weakness to accumulate risk assets.